silver market just broke. And I don't mean a temporary dip or a normal correction. I mean something fundamental just shattered in the global supply chain, and the ripple effects are going to touch every major industry you can think of. Right now, as I'm recording this on December 28th, 2025, silver is trading above $80 per ounce. Let me put that in perspective for you. At the start of this year, silver was around $30. That's a 158% gain in 12 months. This isn't speculation. This isn't hype. This is a full-blown supply crisis unfolding in real time. And here's the kicker. This isn't just about investors making returns or traders riding a wave. This is about the physical metal disappearing from global markets. Major mints in Canada and the United States have completely run out of silver coins and bars. Trading hubs in London and Shanghai are seeing inventory levels collapse. And futures markets are showing something called backwardation, which is a technical term that basically means everyone wants silver right now, not later. When that happens, it signals genuine panic in the physical market. So, what triggered this chaos? 3 days ago, on January 1st, China implemented new export licensing requirements for silver. Now, China isn't just any player in this market. They control somewhere between 60 and 70% of the world's silver supply. And, starting this year, only large state-approved firms with minimum production of 80 tons annually and at least $30 million in credit lines can export silver. That effectively shut down dozens of smaller exporters overnight and put Beijing in direct control of global silver flows. But here's what most people are missing. This didn't happen in a vacuum. The silver market was already on the edge before China made this move. For 5 consecutive years, global silver demand has exceeded supply. In 2025 alone, demand reached 1.24 billion ounces, while supply only hit 1.01 billion ounces. That's a shortage of 230 million ounces. And now, with China restricting exports, analysts are projecting that annual deficit could more than double to over 5,000 tons. Let me break down why this shortage is happening. Because it's not just one thing, it's a perfect storm of factors all hitting at the exact same time. First, solar panel manufacturing. Solar demand for silver grew by 64% last year. And here's the thing about solar panels. There's no easy substitute for silver in photovoltaic cells. It's the most conductive non-precious metal, and manufacturers need it to make efficient solar panels. As the world pushes toward renewable energy, every percentage point increase in solar adoption translates directly into more silver demand. And solar has now surpassed jewelry as the single largest source of silver demand globally. Second, electric vehicles. Every battery electric vehicle uses between 25 and 50 grams of silver in various electrical components, from battery management systems to power inverters. As EV production ramps up globally, that's millions of additional ounces of silver getting consumed annually. And unlike investment silver that can be resold, this industrial silver is gone forever. It's permanently consumed in manufacturing. Third, artificial intelligence hardware. This is the factor almost nobody is talking about. AI servers, high-performance computing chips, and advanced semiconductors all require silver for conductivity and thermal management. As the AI boom continues, data centers are being built at an unprecedented pace, and each one needs massive amounts of silver in its infrastructure. Fourth, and this is critical, silver is primarily a byproduct. About 70% of silver production comes from mining copper, zinc, and lead. It's not usually the primary target. So when copper prices are low or zinc mines aren't profitable, silver production drops as a side effect. You can't just spin up a new silver mine quickly because the economics don't work for pure silver operations at historical price levels. And fifth, geopolitical stockpiling. Central banks and governments are quietly accumulating physical silver as part of strategic mineral reserves. Unlike gold, which is purely monetary, silver has this dual nature. It's both a precious metal and an industrial commodity, which makes it strategically valuable in a way gold isn't. Now, let's talk about what China's export controls actually mean in practical terms. The new licensing framework isn't technically a complete ban, but here's how it works in reality. Only companies that produce at least 80 tons of silver per year and have access to $30 million credit lines can even apply for export licenses. That immediately disqualifies hundreds of smaller refiners and traders who were previously moving silver freely across borders. And the companies that do qualify? They're all state-aligned entities that Beijing can pressure or control through other means. This gives China unprecedented leverage over global supply chains, and they've done this before with rare earth elements. Between 2010 and 2015, China restricted rare earth exports, causing prices to spike and forcing Western manufacturers to scramble for alternatives. Some companies went bankrupt, others moved production to China just to secure supply, and even after restrictions eased, China maintained dominant market control. Silver is following the exact same playbook. By controlling exports, China can ensure domestic industries have priority access, while everyone else faces shortages and higher prices. Chinese solar manufacturers, EV producers, and electronics companies will have stable supply while Western competitors struggle. And here's the strategic calculation. China knows that Western nations are trying to build domestic solar and EV industries to compete with Chinese manufacturers. By restricting silver, they're making that much harder and more expensive. The immediate market impact has been dramatic. In Chinese spot markets, silver is trading at significant premiums compared to London and New York benchmarks. That premium tells you everything you need to know about physical scarcity. When Chinese buyers are willing to pay substantially more for immediate delivery than the global spot price, it means they can't get enough metal through normal channels, and the volatility is extreme. Just in the past week, silver has moved up more than $10 per ounce. That's unprecedented volatility for a commodity market. On December 27th, silver surged to $79.25 before pulling back slightly. Then it pushed through $80 on December 28th. These aren't normal market movements. This is what happens when physical supply constraints meet inelastic industrial demand. Let's talk about who gets hurt by this. Solar panel manufacturers outside China are in serious trouble. Companies in Europe, the United States, and India that were trying to build domestic solar industries suddenly face a critical bottleneck. Silver represents a small percentage of total solar panel costs, but it's absolutely essential. You can't just substitute copper or aluminum and expect the same efficiency. So manufacturers have two choices: pay whatever price necessary to secure silver or shut down production. Neither option is good for the renewable energy transition. Electronics manufacturers face similar pressure. Smartphones, laptops, appliances, industrial control systems, they all use silver in various components. As prices rise and supply tightens, manufacturers will either absorb higher costs, pass them to consumers through price increases, or look for ways to reduce silver content. But reducing silver usage in electronics often means reduced performance or reliability. The automotive industry is watching this crisis closely because electric vehicle production timelines are already aggressive. Automakers have made massive commitments to electrification, with billions invested in new factories and supply chains. A prolonged silver shortage could slow EV production right when demand is accelerating. And for traditional automakers trying to compete with Chinese EV manufacturers, this puts them at an additional disadvantage since Chinese companies will have preferential access to domestic silver supply. Investment implications are massive. Physical silver bullion demand has exploded. Premiums over spot price have increased significantly because dealers can't source enough product. Some popular silver coins are sold out for weeks, and this creates a feedback loop. As premiums rise and availability drops, more investors want to buy, which drives premiums even higher. Silver mining stocks are seeing increased attention, but here's the problem. You can't just turn on new silver production quickly. Developing a new mine takes 5 to 10 years from discovery to production. Existing mines can try to increase output, but most are already operating near capacity. And remember, most silver comes as a byproduct of other mining operations. So increasing silver supply often means the economics have to work for copper or zinc mining first. Silver ETFs are seeing complex dynamics. Some investors are buying ETF shares as a convenient way to gain exposure. But other investors are demanding physical delivery, which drains ETF holdings and tightens physical supply even more. The largest silver ETF saw holdings decrease by over 56 tons in just one day recently, which tells you institutional holders are pulling physical metal. Now let's address the comparison everyone's making: Bitcoin versus silver. Some crypto advocates argue that Bitcoin is a better store of value than physical metals because it's easier to transport and store. And there's a logic to that for purely monetary purposes. But here's what they're missing. Silver's rally isn't primarily driven by monetary demand. It's driven by industrial consumption that can't be substituted. Bitcoin can't make solar panels work. It can't improve semiconductor conductivity. The two assets serve fundamentally different purposes. That said, there is a relationship. Both silver and Bitcoin are benefiting from concerns about currency debasement and monetary expansion. Central banks have added over $120 billion in liquidity to the U.S. banking system this year through various operations. When fiat currency supply expands, hard assets tend to appreciate. So in that sense, silver and Bitcoin are both riding the same macroeconomic wave, even though the specific supply-demand dynamics are completely different. Looking ahead to 2026 and beyond, several scenarios could play out. Best case scenario, China loosens export controls after achieving whatever strategic objectives motivated the policy. Global supply chains adjust, maybe with new production coming online from Mexico, Peru, and other major producers. Industrial users find ways to reduce silver intensity in their products through engineering improvements, and prices stabilize at a higher level that balances supply and demand. Medium case scenario, export controls remain in place but aren't tightened further. The market operates in a permanently constrained environment with China controlling the tap. Western nations invest heavily in recycling infrastructure to recover silver from electronic waste, which becomes economically viable at higher price levels. Some substitution occurs in less critical applications, but high-value uses like solar and semiconductors remain dependent on silver. Prices stay elevated but eventually find a range. Worst-case scenario, geopolitical tensions escalate, and China uses silver exports as a bargaining chip in trade negotiations. They tighten controls further, creating acute shortages. Solar panel production outside China stalls, EV manufacturing slows, electronics costs spike. And this becomes a national security issue for Western governments, prompting emergency measures and strategic stockpiling. Prices could go substantially higher if physical shortages become severe enough. What's interesting is that major institutions are starting to take this seriously. You're seeing increased coverage in mainstream financial media. Bloomberg, Reuters, Financial Times, they're all running stories about the silver crisis. That's significant because it wasn't getting much attention until recently. When institutional coverage increases, it often precedes institutional capital flows. Pension funds, sovereign wealth funds, and other large investors start allocating to commodities they previously ignored. Historical context matters here. Silver has been money for thousands of years. The US dollar used to be backed by silver. The phrase, not worth a continental, comes from Revolutionary War currency that was not backed by precious metals and became worthless. The silver to gold ratio has fluctuated throughout history, but silver has always maintained value because of its unique properties. Most conductive element, most reflective element, and essential for modern technology. Right now, the gold to silver ratio is around 65 to 1. That means 1 ounce of gold equals about 65 ounces of silver in value. Historically, that ratio has been as low as 15 to 1 and as high as 100 to 1. If silver's industrial demand continues growing while supply stays constrained, we could see that ratio compress further, meaning silver outperforms gold on a percentage basis. Some analysts are making bold predictions. We're seeing targets of $100 per ounce, $150 even higher. Are those realistic? Hard to say. Markets can overshoot in both directions. But the fundamental supply-demand imbalance is real, the industrial consumption is real, and China's control over exports is real. Those aren't speculative factors. They're happening right now. For everyday people, this matters even if you never buy an ounce of silver. Higher silver prices feed into the costs of solar installations, which affects the pace of renewable energy adoption. They feed into electronics prices, which you pay when buying phones and appliances. They affect EV prices, which impacts transportation costs. And if the situation gets bad enough, it could slow technological progress in areas that depend on reliable silver supply. The geopolitical implications are profound. China now has significant leverage over Western industrial policy. If they want to concessions on trade, technology transfer, or other issues, they can threaten to tighten silver exports further. This is economic statecraft in action. And it's a reminder that control over critical resources translates directly into geopolitical power. What's the takeaway from all this? First, understand that this is a structural shift, not a temporary spike. The supply-demand fundamentals have changed in a meaningful way. Second, this affects multiple industries and could be an inflationary pressure point going forward. Third, China's control over critical mineral supply chains is a strategic advantage they're willing to use. And fourth, this is probably just the beginning of resource nationalism becoming a bigger factor in global economics. The silver market broke on December 28th, 2025, and the consequences are going to unfold over months and years, not days and weeks. Whether you're an investor, a business owner, or just someone trying to understand the global economy, this is a story worth following closely. Because what happens with silver will affect energy, technology, transportation, and geopolitics for years to come. The chaos is just beginning.